US housing stock, Toll Brothers, for example, one of the big home builders over there. The US housing cycle is only at best halfway through its upturn. And yet everyone's acting as though interest rates are going to cause it to be the end of the cycle. And it's selling on 7 times earnings, which is pretty reasonable. Orders are growing at 20% year on year. So we think there's another 2 or 3 or 4 or 5 years left in the US housing cycle. So at 7 times, it's pretty interesting. Another stock that people would be familiar with, and it's a very simple business, is Bank of America. Great deposit franchise. It's paying back 100% of its earnings in buybacks and dividends because the Fed has said you've got enough capital now. 10 PE, which is very attractive. KKR is the other one. A lot of investors might know it because it was pretty famous historically with a lot of the big takeovers on Wall Street. And it's a classic in terms of, these are really sharp management. Sharpest on Wall Street, I would argue, amongst that industry, the alternative asset managers, private equity, credit. So KKR is among that mix. They're companies that were founded a long time ago. They've been in business, 50 odd years. So they're seen as specialists in their business. And the interesting thing is a couple of years ago, traditional managers have been selling at 15 PE. These alternatives like KKR are selling at single-digit PEs. One that might be interesting that I would argue you might want to avoid, because I think their sector is going to have a few troubles at some point in the next couple of years. And it's represented by Ronald McDonald, McDonald's. So the interesting thing about McDonald's, it's been a prime beneficiary of lower rates, because if you think about McDonald's, it's actually a property business. You go back 5, 6, 7 years, they haven't grown their underlying earnings. Stock price has gone up because of re-rating with lower interest rates, perception it's defensive. They've also been selling all their company-owned restaurants. And the reason being is they get royalty streams in return, and Wall Street values royalties much higher than ordinary revenues. They take the capital, buy back stock, play the engineering game to its fullest extent. And so they're now pretty fully valued. They're selling it off to their franchisees, the company-owned restaurants, who are borrowing from the bank to buy. And one of the issues with the franchisees, they're now facing potentially margin pressure because they now are fully responsible for labour, rent, food costs, interest costs, and they've all inflected. And to help them out, they're selling off the underlying property to a passive property investor who's probably borrowed from the bank to buy the property. So the whole system's become leveraged right at the point of an inflection in interest rates.
That's another comparison there with the Australian banks, I guess, in that they are so reliant on another asset class, in our case, housing, and in that case, it's commercial property.
Yep. And if something goes wrong, who has to step in to protect the franchisees? It's McDonald's. And I don't think the market's allowing for that in the valuation.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.